Welcome to the Commercial Real Estate Show. I'm Michael Bull, your host to the world of commercial real estate. Our topic today, apartments, the multifamily industry. You know, the multifamily sector was the first one to perform better after the recession. You know, the property type's done well. You know, we've had favorable conditions, including economic conditions that have impacted the multifamily market. And, we've also had some other factors that surprisingly, like the demographics and the millennials. So the apartment market's done well. Well, that does bring up some questions, doesn't it? Like, how long will the prosperity last? And then new construction's really kicked up. So how is that going to impact the market? And then some people are concerned to see how is the return of the housing market going to affect multifamily. We'll find all that today and more. Please welcome my first guest is Stephanie McCleskey, Director of Research with AXIOMetrics. Stephanie, thanks for joining us today.
Good morning, Michael. Thanks for having me. I'm excited to be on the show.
Well, we appreciate you being with us. And to start us out, how has the apartment market performed in the first quarter of 2014, and how does that compare to where's the trend there?
Sure. Well, based on AXIOMetrics research on the apartment market, results have really been mixed depending on which markets you're looking at. At a national level, annual effective rent growth for the first quarter shook out at about 2.9%. So it's slowed from the previous years. 2011 through 2013, we saw rates anywhere from the 3 or 4 or even 5% range at a national level. And so now it's slowed down a little bit to be at 2.9%. The long-term average is 2.1%, so we're still trending above what we've seen historically. Now, the national occupancy rate is at 94.4% for the first quarter. We're expecting it to peak out a little bit, but it's remained pretty steady even with the amount of new supply that's come online.
Right. It's important to note, like you said, that 2.9%, that's very healthy, isn't it?
Yes, it's actually a really great rate, and there's some markets that are doing phenomenal right now, other markets that are struggling a little bit more, but 2.9% definitely by historical standards is a very healthy growth rate.
So what do you guys expect moving forward in 2014 and beyond?
Sure. Well, again, it depends on the markets in which you're located, but overall, at a national level, we're forecasting effective rent growth to end the year 2014 at 2.7%. The occupancy rate is going to end the year around 94.1%. We're expecting rent growth to continue to slightly moderate over the next couple years and then pick back up. It really all comes back down to the apartment fundamentals and how much new supply we come online, what's job growth like, demographics, as you had mentioned earlier. But it's still, again, healthy for 2014.
Right. That's good news. And what about Class A properties and Class B and Class C? I mean, our listeners have all types of properties around the country. What do you see for performance variances there?
Sure, and actually now more than ever, AXIOMetrics, we encourage everybody to break down by asset class because you can't really determine the health of a market by just looking at the market overall. You've got to break it down by asset class and by even submarket. Right now we're seeing Class B leading the pack at 3.4% for March of 2014. Class A struggled the second half of 2013. A lot of that stemmed from the new supply that was coming online. But it is back on the upswing since about November of this last year. So it's getting better. And then Class C slowed for the second half of 2013, although it was in the lead for the majority of the 2013 among the other asset classes. Right now it's at about 3%, so it's close to the Class A growth rate. Occupancy levels for all asset classes, Class A and B, are very close, tight in line with each other at around 94.9%, and then Class C is a little bit behind at 93.7%.
Okay, so there's still a lot of opportunities out there, it sounds like, in the Class B and C properties. And Stephanie, one of the things that some of our listeners think is that the downturn in the housing market really helped the apartment market, and they're curious about how an improving housing market may impact the multifamily market. What do you guys think?
Well, really, like I had mentioned before, it comes back to apartment fundamentals. So new supply, job growth, how much new supply are we going to see coming on into the U.S., how many new units are going to be built, and then how well are they absorbed. So depending on how well we are able to absorb the new supply that comes in, we may continue to do very well into the future.
Okay, and what do you see for new supply? Some markets seem to have a lot of construction going on.
Right, for sure. There was quite a bit of new supply delivered in 2013. At a national level, we saw around 155,000 units delivered into the U.S., and this is based on AXIOmetrics construction pipeline. So this is actually identified apartment units across the U.S. 2014, we're expecting around 259,000 units to be delivered. We expect supply to peak in 2014 and then slow a little bit. And some of the reasons why we would see construction activity slow are construction costs. Is it getting too expensive to make some of these deals pencil out? Is effective rent growth slowing? There's already concerns for oversupply in some of the markets, so there would, especially the urban core. So more construction would be needed in the suburbs to maintain elevated construction totals into the future.
And what do you hear about construction cost? Are your clients telling you that their costs are really increasing quickly?
We have heard from some of our clients that are developers, especially in throughout 2013, that some of the construction costs have risen, and they've actually had to decide a no-go on some of the deals that they were trying to develop. So it's interesting how it's impacting any new developments that they're trying to get to pencil out, and if they can't raise the price of what they'd get for revenue for the property because the construction costs are too high.
Right. And we're talking with Stephanie McCleskey with AXIOmetrics about the apartment market. And Stephanie, this new supply, where's it the largest impact? Is there certain cities, or is it certain core urban markets? What areas are most affected?
Well, there's been a lot of speculation. There's about Washington, D.C. There's been a lot of deliveries into Washington, D.C., especially in 2013 and expected in 2014. In 2013, we saw around 7,300 units delivered. In 2014, we're expecting almost twice that amount at 15,800. Again, this is our identified supply number based on AXIOmetrics construction pipeline. Job growth really slowed down, according to the Bureau of Labor Statistics for Washington, reporting about 0.1% relative job growth compared with the U.S. average of 1.6%. The annual job gain for March 2014 for Washington, D.C. was around 3,300 jobs. And if you take the job gain, and if that remains the same for the rest of 2014, and you took a jobs to new units delivered, that would be about 0.2 new jobs for every new unit delivered in the Washington, D.C. metro. So that's not very many new jobs for all of this new supply that's coming online. So there's a lot of concern there. Another market that has quite a bit of new supply where there really isn't as much concern is Houston. The job growth in Houston is phenomenal. It's 8,100 annual job gain for March. And for 2014, we're expecting around 6,100 or 16,100 deliveries. So that's about 5 new jobs for every new unit delivered or being built. So it's a much healthier ratio.
And what are the ratios that make sense there? One's not good, five's great. What makes sense? Five
is around is a healthy ratio for the multifamily industry.
Okay. And what are some other factors that are impacting the multifamily market?
Some other factors that are impacting the multifamily market, affordability. So it really comes back to, it's always going to come back to the apartment fundamentals. What is the new supply and the job growth? But not just the new supply, but what are what pricing are these new units trying to get? And if there aren't enough renters available in that space to afford that unit, they're going to have a difficult time leasing up, and the absorption rates for that property are going to be fairly low. So those are some of the factors that would influence the job growth. The rent growth in a particular market. And let's see. What else would be something that would?
Well, let me ask you about this. What are some opportunities, some areas for opportunities in the multifamily market? We're close on the break, but what are some quick tips for opportunities?
Opportunities for developers. A lot of the, it's really paying attention to all of the different factors that could influence in the apartment market, not just how many new units are being delivered, but paying attention to the economic indicators. What are the demographics for a particular market? Are there a lot of people migrating to a certain area? What is the age of the typical person that's migrating to that area? Is it within the renter age of 25 to 34? Those are the main renters for the apartment industry. So looking at all of the different factors, I think, is important.
Stephanie, thanks for joining us today. We appreciate it.
Sure.
For more from AXIOMetrics, visit AXIOmetrics.com. I'm Michael Bull. Stay with us. More on the apartment market. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Florida International University, Real Crowd, and Bull Realty Commercial Brokerage, a great place to do business. For more information on these companies or to access additional podcasts, videos, or blogs, visit commercialrealestateshow.com.